In the second quarter of 2025, something happened in global markets that almost no American investor noticed. But every major hedge fund has quietly started preparing for it. Middle Eastern sovereign wealth funds, the same funds that bought U.S. Treasuries for 40 straight years, just dumped $39.8 billion worth of U.S. debt and shifted that money into a single asset class that should terrify every stock market investor. Not oil, not real estate, not crypto, silver. $39.8 billion in physical silver bars sitting in vaults in Dubai, Qatar, and Istanbul. And if you think this is normal rebalancing, let me remind you of something. The last time Gulf sovereign funds made a move like this was early 2008, 6 months before the S&P 500 collapsed 56%, 6 months before Lehman evaporated, 6 months before the entire U.S. credit system froze. History isn't repeating, it's accelerating. The warning sign. No one saw coming. For decades, Gulf sovereign funds, Saudi Arabia, UAE, Qatar, Kuwait, were among the largest buyers of U.S. government debt. They funded America's deficits, bought U.S. bonds, and held dollars as reserves. But in Q2 2025, something snapped. For the first time since 1983, Gulf sovereign funds became net sellers of U.S. debt. And here's the part no analyst is talking about. Every single dollar they pulled out of treasuries went into physical silver, not ETFs, not mining companies, not futures contracts, actual bars, stored offshore, untraceable, unseizable. This is not trading. This is escape. Why are they running from U.S. debt? Because the people who control trillions, literally the largest pools of capital on Earth, are seeing something that you and I don't have access to. And it all comes down to energy data, geopolitical intelligence, and credit risk signals that appear months before they show up on CNN or CPI reports. Here's what they're seeing. Global shipping costs have doubled in 90 days. Gulf nations control 40% of the world's shipping routes through the Strait of Hormuz. Their internal data shows something terrifying. A massive slowdown in U.S.-bound shipments starting in May 2025, 5 months before any American consumer data will show it. U.S. energy demand is falling. When American factories slow down, Gulf states know before anyone else because they see it in oil futures, refinery orders, and export scheduling. And right now, their data shows a contraction that matches late 2007. Foreign holdings of U.S. bonds are shrinking at the fastest pace since 2015. When foreigners stop buying U.S. debt, interest rates must rise. When rates rise, markets collapse. It's mathematical, not emotional. And Gulf sovereign funds are front-running that collapse. Why silver, not gold this time? Silver has 3 traits that make it the ultimate crisis hedge in 2025 to 2027. Extremely low global inventories. Current global silver stockpiles are the lowest in 24 years. And industrial demand, especially from AI data centers and EVs, is exploding. 2. It's both a monetary metal and an industrial metal. In a recession, monetary metals rise. In an AI infrastructure boom, industrial metals rise. Silver benefits from both. 3. It's outside the U.S. banking system. Physical silver stored in Dubai or Turkey cannot be frozen, seized, hacked, or blocked. For sovereign wealth funds, silver is the perfect geopolitical hedge. The shift that echoes 2008 but bigger. In early 2008, Gulf sovereign funds quietly withdrew $22 billion from U.S. treasuries. Nobody noticed. Western media ignored it. But months later, the U.S. housing bubble burst. Credit markets froze, Lehman collapsed, oil crashed from $147 to $32. The S&P fell 56%, now compare that to 2025. A $22 billion withdrawal in 2008 versus $39.8 billion in 2025, adjusted for inflation. That's nearly double the 2008 scale. They're not guessing, they're signaling. What are they preparing for? A U.S. credit downgrade. Gulf banks are pricing an AUS downgrade within 12 months. They see the debt math. They know it's unsustainable. A recession triggered by declining industrial orders. AI server orders, semiconductor demand, and EV production all slowing. This data appears in shipping and energy markets months before it hits earnings calls. A geopolitical event involving the dollar. Multiple Gulf nations are pricing oil contracts in yuan, dirhams, and rupees. Dollar dominance is shrinking quietly, slowly, then suddenly. Rising risk of asset seizure. If U.S.-China tensions escalated, the U.S. freezing foreign-owned assets becomes more likely. Middle Eastern funds watched the Russia asset freeze and decided, we are never letting that happen to us. The timeline they're betting on, using historical parallels and current capital flight velocity, here's the timeline sovereign funds are positioning for. Q for 2025, market stalls, volatility spikes, Q1 2026. Bond market stress becomes public, Q to 2026. Equity markets begin a sharp correction, Q3 2026. Credit markets tighten, corporate defaults rise, Q for 2026. Full recession, 2027 to 2028, multi-year recovery. This is almost an identical pattern to 2007 to 2010, but triggered by debt, not housing. What should retail investors do? Not financial advice, just the logical interpretation of data. Reduce exposure to high-valuation tech, especially companies with inflated P/E ratios driven by AI hype. Increase cash reserves 20 to 30%. Cash buys opportunities when markets collapse. Build a defensive metals allocation 10 to 20% gold plus silver mix. Silver has more upside in this cycle. Shift toward defensive sectors. Utilities, energy, healthcare, consumer staples. Avoid speculative, unprofitable growth stocks. They're the first to collapse. The final warning, the smart money is leaving first. History has a pattern. In 1999, insiders sold tech before the crash. In 2007, Chinese investors sold U.S. assets first. In 2020, hedge funds exited weeks before the COVID sell-off.
In 2025, Gulf sovereign funds are dumping us debt and buying silver. Every time, the smart money leaves quietly. Every time, retail investors stay inconfident, distracted, unaware. Every time, the final group to react loses the most. And here's the truth, sovereign wealth funds don't make emotional decisions. They move based on intelligence, data, and geopolitical signals the public never sees. And if they're preparing for something, maybe you should too. If this analysis opened your eyes, subscribe for more, because the next 12 months may be the most important financial year of your life, and the people who prepare now will be the ones who survive the storm.